All right. Thank you everyone for joining today's session. Today we're going to talk about technical analysis. And if you don't know me, my name is Jessica Inskip. I'm the Director of Education and Product here at OptionsPlay. And my job is to make sure that we're educated on those complex topics. We have that understanding, that foundational grasp that we can grow and compound upon. And then, of course, translate that into product and how we actually apply and utilize that, which requires market analysis and that entire plethora that it is of understanding the stock market. Nonetheless, let's go ahead and go through today's session. So, I do have a couple disclaimers before we get started. Today, we're going to talk about options briefly because this is an options company, and we're going to make sure that we discuss how technical analysis can certainly translate into that. But there might be some securities that are utilized. It's purely for informational and educational purposes only. It's not considered a recommendation or a solicitation to buy or sell any securities. It's not intended for individual tax, legal, or investment planning advice. We do talk about options. Know that options are complex. They're not for everyone. They require a separate agreement. And the options disclosure agreement is something that's distributed by the OCC, which you can find on First Trade's website or the OCC.com. And then additionally, OptionsPlay is a third party that's not affiliated with First Trade or any of its affiliates. So anything that comes out of my mouth is not constituted as an opinion of First Trade. So important to know those disclaimers as we go through this, especially as we're dealing with the complexities like options and that of which is technical analysis. So let's talk about what we're going to talk today. First and foremost, let's talk about the value of technical analysis, why it was built, the mindset of a technician, the importance to understand the value that it can bring to perhaps enhance your overall investing strategy. Second, we'll talk about option strategies. So the way that we frame our mind with option strategies and how we can marry that with the value of technical analysis, just to get our minds in the right spot. Then we'll move on to different price analysis and patterns so we can understand the fundamentals of technical analysis, the different indicators, the different categories, some chart overlays, momentum indicators, and of course, if there's some time, Q&A. So let's talk about different option strategies. So first and foremost, if you're an options trader, you tend to fall in one or two buckets. And we call that seeking income or gaining directionally. And that could be just from a strategy perspective. You know, when you are dealing with a option, we're adding a layer of complexity because not only is the option derived from the underlying security, it also has a time and implied volatility component, that extrinsic value component. And that complexity it can be used for different things. But what the takeaway from that, if you've never dealt with options before, is that it is derived from an underlying security, which means when we're trading options, there is a goal associated with it. You know, if you're going to be neutral, so you don't expect the stock to go anywhere, or, you know, if you're largely directional, where you expect it to go either way, up or down. That two-dimensional aspect. When we layer on options, because it really, as the way the market looks, or way that really anyone looks at the market, or we perceive it on an initial level, is in this two dimensions, right? Which is up or down. We think that the stock is going to go up, or we think that the stock is going to go down. When we layer on options, almost add a third dimension, which is path, because now we have expiration dates. We can see this volume within certain time frames. So it's more of a different view where options can even be used for analysis if you don't trade them yourself. But ultimately, understanding creates those elements that help you elevate your trading and financial literacy in general. Nonetheless, when you are trading options, you have to know which strategy aligns to your goal. And that strategy could be seeking income or gaining directionally. When we're talking about strategy examples that seek income, that means you're on the sell side of options. Your intent for that option is to not go up in value as much as possible. In fact, you want it to expire worthless. Those tend to be covered calls, cash secured puts, or credit spreads. If you're gaining directionally, you're expecting a sharp directional move in either direction. So if you're bullish, perhaps is a long call, bearish, a long put, and then debit spreads are utilized to cap your gain potential. if you will. So these are your ideal outcomes. Just keep those in mind as we're going through technical analysis. This isn't a in-depth option session today, but we want to make sure that we talk about how we can utilize technical analysis to enhance our overall strategy. And so our strategies begin with our perspective and the underlying security, and the technical analysis aspect is going to help us get some moves. Now, I know this isn't a session on the Greeks today, but we like to add this in nonetheless. You don't have to pay too much attention to this. It's just another way of saying when we are purchasing options, we're looking for sharp movements. When we're selling options, we are not looking for sharp movements. So these are things that we go through and understand when you're going through that advanced concept from that financial literacy journey with options. And we can bring this together with technical analysis and bring it in a lot. But for today's session, all that you need to know for bringing in options to this picture is what are bullish strategies, what are bearish strategies, what are strategies that are going to profit from a neutral movement, so not moving as much with a slight directional bias, or which ones are more largely expected from a sharp directional bias. So the Greeks help us understand that. This is a great view of just bringing it all together. The way that we put it this way is, if you understand long calls really well, everything else is essentially a mirror if you've never seen a T-chart like this before. Not going to spend too much time on this. We've got some other sessions we've done on the Greeks today. We're definitely going to focus on that technical analysis aspect. So let's talk about the value of technical analysis. So first and foremost, what is it? It's the study of market data. It is recognizing patterns and events via mathematical studies. So we are looking at price patterns, essentially, when we look at things like Fibonacci retracements, or that is found all throughout nature even. So it's looking at repetition, and repetition creates almost like a branding of the security. If it reacts a certain way to earnings, or it reacts a certain way to interest rate changes, or the reactions turn into patterns, and then patterns that are consistent turn into investment behavior. So that's where it all translates together. So it really is utilizing the data to assess investor behavior, which is identifying areas of supply and demand. The market is a function of supply and demand almost in every aspect, in my personal view. And that could be from supply chains, interest rates, the way consumers are spending. But from a technical view, supply means that there are a lot of sellers, so a lot of shares available, whereas demand is there are a lot of buyers. So when we're speaking about supply and demand in the terms of a technical analysis, if you're a technical analyst, it's areas where we can find a lot of buyers versus a lot of sellers. And there is some psychological aspect to that as well that we can certainly discuss. But we utilize those together, and it helps us analyze future price. We'll decipher that potential direction of the security based on past behaviors. Past performance is never indicative of future results. However, we can utilize it to understand. And if we understand, then we can make more educated decisions on our trading aspects. So the basic assumptions of technical analysis. If you have ever studied technical analysis, this should be the first thing that you read somewhere. This is in all of the books. When I first learned personally, almost 15 years ago now, this is whatever all of technical analysis is founded on. First and foremost is that the markets are forward-looking. The market discounts everything, and it prices in new information as it comes to light. So that is the assumption that price market theory is playing out, essentially, because markets are constantly trying to understand what is the price of this underlying security, the stock, this indice, which all translates together. What is this actually worth? And when new information comes to light, it changes what that's worth. So, for example, earnings comes out. Earnings came out for Abercrombie, and that was much higher than anticipated. Therefore, the security immediately reacted, and it is reacted in price, as in that stock is worth more value because the earnings was higher than anticipated. That is an example. Or interest rates. All of a sudden, the Fed, I think 2 years ago, announced that they're going to raise interest rates. Well, the second that it raises interest rates, there's this domino effect that occurs where without you as a understanding the economics or going through that, when purely a technical basis, the assumption is this has been priced in. From a technical perspective, yes, I can understand that these events are happening, but I understand that when these events do occur, the market immediately reacts. That's what that means. The market discounts everything as in prices and new information as it comes to light. So information is already assessed. And that's why the market moves quite a bit. Number two, prices tend to move in trends. They're observable, and much like Newton's law, trend in motion remains in motion until otherwise indicated. So if I see a series of prices increasing, and we'll set up rules and I'll show you how to identify a trend, but that trend is in motion, disciplined strategy here, until something suggests otherwise. And those could be flags, which we'll talk about, and we'll discuss how to understand. And then if it's something for further investigation, what that looks like. And then the third is history often repeats itself. They're patterns and signals we expect repetition. And that is a lot of times fueled by human nature, which is fear and greed. Fear that the market will fall, greed that something is going up in value and it's perhaps chased in value. And we can see that a lot from a technical view, looking at overhyped securities like meme stocks and things to their demise. So that's what this means when we're looking at the basic assumptions of technical analysis is these three things. Keep this in your mind as we bring this together and view how technical analysis really works. So whenever we are determining strategy, this is where we're going to layer it on from the trades. So whenever we are thinking of a trade or technical analysis, rather, technical analysis is going to help us give us an idea and help layer on this other aspect to our trading strategy. However, you have to place a trade in order to generate profits off of that. But when we're looking at trades such as option strategies, which add that complexity, this is why we started with know if you're looking to gain directionally, if you're seeking income, where you feel the stock is going to go. If you understand those strategies, then we utilize technical analysis to mirror that or to complement it, if you will. So if we expect sharp movement, we've got clear magnitude, then these are the strategies that we'll lay out. We're going to come back to this later on, but again, these are framing the mind work before we go into the meat of how this all actually works. So starting with support and resistance lines. So this is probably the first thing that you'll notice. And what I do want you to keep in mind is if you've never looked at a chart before, I'm sure you have, is time frame makes a difference. So whenever we are looking at a chart and we're trying to assess these patterns, this is a clear pattern that's drawn out for you, almost like a ball bouncing from floor to ceiling. This is considered an area of support, which again is an area of demand. Whenever this security falls down to here, so it failed to make a lower low. So a downtrend is considered a series of lower lows and lower highs, which is generally depicted as a straight down line. But from a technical view, you want to see lower lows and lower highs. That is the trend in motion until otherwise indicated. This failed to make a lower low and then began overcoming its previous lower highs here. So we would say this is a shorter term uptrend, but it's longer term stuck in consolidation. What does that mean? Oftentimes you'll hear charting where some technical analysts look at 2 to 3 years and candles represent your intervals. So if this was a week's time frame, this would be a much, as in this was 2 to 3 years and each candle represented a week. That's a stronger trend because it has a larger data set. It's math there. If there's a lot more numbers, then there's more validity to it than if this was perhaps a shorter time frame where each candle represented 1 minute. Then that doesn't have as many data or time really to say that that trend is in motion. So different charts can definitely paint you different pictures because they're different time frames. So keep that in mind. This is a longer one. You can see because on charts at the bottom, this one has dividends and this is earnings. So this is over a longer period of time, and this at the bottom here is volume. So meaning from a trading perspective, we see that there is a series of lower lows and lower highs. This is the shorter term downtrend. It's overcoming its area of lower lows and beginning to make higher highs and higher lows until it doesn't, which was an earnings. See how earnings here immediately adjusted the price, hence that E there. But this created this failure to make a higher high is a point worth flagging. This continuous failure to make a higher high becomes an area of supply. So buyers did not come in, sellers overtook buyers. That's what it means. So whenever you hear that terminology, is demand going to come in when we have a 1% fall? If so, then we're stuck in that trading range. And is there going to be enough buyers to overcome this clear area of resistance, this clear area of supply? That's what all that terminology means. And like a ball bouncing from floor to ceiling, as this constantly tests these points and that those still stays true. So that trend in motion where this still remains to be an area of demand where buyers are coming in, gets up to this area of supply, sellers are coming in. Demand, buyers, sellers. And so as this continues, we would expect this to go to here. Maybe there's a smaller area here, but the trend is in motion until otherwise suggested. So we've now got this zone or this consolidation area of about $8 because this is $40 to $48.12 right here. This can help us gives us an idea of this stock being stuck in this area, and perhaps there is a trade opportunity that we can identify off of that. So there's some moments there. So for example, if we've got a clear direction and we've got a clear stopping point, this is where if we don't see a failure or we don't see a higher high where supply is coming in, then this perhaps is a debit spread where we would expect this to go down until this point. So we would buy a put here and then cap our gain potential at $40 because if we have a debit spread, no matter how low the security goes, we're capping our gain potential. So that's a potential trade opportunity. And then the inverse is true. If you believe that the stock is going to go up to its next area of resistance, perhaps you'd buy a call. So we have a directional view and we have a magnitude and stopping point. So clear price target, that gives us an idea of the type of strategy. That's why we want to start with layering on options is we have to understand, are we expecting a directional move? Do we expect it just to remain exactly where it is? And then there's that layer of implied volatility that we have to talk about, which magnifies options prices, which we've talked about with first trade before and important to understand as we're diving into technical analysis. Now, I want to bring in the psychological aspect of this and why it makes sense in my mind. So again, personal opinion here. When we think about this, if you owned this security, whatever it may be, and it fell to here, and then you held this security, and then perhaps this is where you bought it, and you say, "Oh, you know what? I think it's going up higher. Earnings are coming out, whatever it may be, so around $48." Then it falls again, but you still hold it. Then it makes it back up to $48. You might sell it there. It's the psychological aspect because you see a lot of price points. That means a lot of people perhaps own that security at 48. So the psychological aspect is, well, if I've held this security, I've had losses, I'm finally break even. Their sellers could come in at that point because a lot of supply exists. So that's what it means by areas of supply and demand. There is ownership at this price. It's been in a downtrend. Do people want to buy more when it goes past this price? Or are they going to sell their security that they've held at that moment? Are they going to cut losses or are they going to, is there a reason to believe? So that is the psychological aspect that I think is important just to think about when we're discussing technical analysis. All right, so that's support and resistance, layering on the options aspect. But if you're identifying support and resistance, know that multiple test of a trend line, add multiple validation, almost like you have that one friend who is consistently late and may start where they're late one time, but then if they show up to the meeting late consistently, that is now the trend. You know that person will be. So the more that something is tested and proves to be true, the more valid that trend becomes. Fun analogy there. Now, looking at a breakout and a breakdown, this is where we're getting in a clear direction, but we don't have a clear magnitude at this point. So say the security in this example here has rallied. We had our area of resistance. Perhaps there was another one here even, but we have this failure to make a higher high here, but demand has come in and overcome that. So now demand has overcome supply. That is a breakout above the clear area of resistance. When that occurs, now we have to layer on our conviction. Are you bullish on the security? As why? When we are, this is one step. Technical analysis has layers to it, and we'll unpeel those layers. But this is a flag, and I would look at this and say, okay, we had a clear area of resistance. Buyers have come in. We believe that the market is pricing in all information. So there is a reason why this has now become a new area. And then what is also important, when this type of breakout occurs, old resistance then becomes a new support. This would be the new support line. If we would expect this to be maintained, but we don't have as many tests as we did with the previous one. So meaning, are you going to wait on time to be on your side? Timing the markets is a difficult endeavor. However, understanding can certainly help create that path, if you will. So if we are bullish, limited, there are two types of strategies that you could deploy here. One, if you're bullish and you expect a sharp directional move, we want positive gamma, that's a long call. If you expect it to remain above 87 where it broke out, then that's where we would sell a cash secured put or perhaps a bull put spread, where that type of strategy realizes its maximum profit when the underlying security just stays right above its strike price. It just needs to move by 1 penny. That's it. That's why it's neutral with a slight directional bias. You don't need to overcome the time value that you purchased, the time value that you're selling on that side. So the time value works in your favor as that option decays. That's what that means. So when we're layering on our change and the trend here, we need to understand, are we expecting more sharp directional moves or perhaps the security remain where it is? And that's where we can figure this out. And if you just flip this on its head for direction, then you've got long puts and perhaps debit spreads. Now, there are other patterns that you can layer onto this that I definitely encourage you to read up on, but double tops and bottoms, which are cup and handles and things of that nature, which can indicate that there's direction changes and moves, cup and handle reversals, flags and pennants. These are continuations of trends and things of that nature that are important to understand, but we're going to go through the introductions today. Otherwise, I'd bore you with too much information. Now, let's talk about moving averages. So moving averages, there are a couple different ones. On your trading platforms, you'll tend to see simple moving averages or exponential moving averages. This is just where it goes back to math. You'd have a time frame, and it's all about mean reversion at this point. A moving average can indicate your trend, and it can act as a means of supply and demand, or really support and resistance in this case. So meaning, we look at the slope of the line and we look at where the underlying security is relative to the line. So on this moving average here, when the slope of the line is upwards trend, it flattens. The Dow theory tells us that there's a period of consolidation before trends change, which is also other continuations, reversal patterns we could perhaps find on the previous slide. we see the moving average begin to slope downwards. That indicates a downtrend. And then the inverse is true, and you can see how this keeps going. So on top of that, this is now acting as means of support. This is the average price throughout the period we have selected. You can layer on different time frames for averages. The common ones are there's a 20-day, 50-day, 100-day, 200-day. Those are looked at quite frequently. If you ever follow my charts, I personally look at 2 to 3 year, sometimes even 5-year charts, and I have weekly intervals, and I look at the 13, 26, 40, and 200 weekly moving averages because I view the market quarterly and I want to see quarterly prices move upwards as we do look at it from earnings. It's just a rolling quarter's worth of prices. So you can layer them all together. The point is, this acts as an area of support. Now this flips to an area of resistance. As there's a breakout, flips again to support, resistance, support once more. So you can see how it's indicative of trend, but it also is means for support and resistance. And the same rules apply. Multiple tests, multiple validation, the stronger the trend is. And then, of course, the same rules apply for the support and resistance that we went through earlier. When you see the breakdown or the indication of that reversal, then that is indication of direction. And if there is direction and magnitude, we define that and you layer on an option strategy associated with that. So those are moving averages, very quickly run through in a nutshell. And another means for trend, and you can utilize all of these together. Now, adding on Bollinger Bands. Bollinger Bands are used for lots of different means. And this is where you've got personal preference coming in, but I like to understand the math in order to define that. So a Bollinger Band takes a simple moving average. So you see the middle line here. Normally it's a 20 period. So in this case, it'd be a 20-day. If this is a daily chart or it's a weekly chart, it'd be a 20-week period. And then the bands are defined by 2 standard deviations. So that could be used in a lot of different ways. It can be utilized as stopping and stopping points to give you magnitude, but it also can be utilized as trend strength. Meaning, think about that. If a standard deviation is just taking the prices of that period, if you are hanging to the lower prices of that period, it's a strong trend downwards because it's not moving to even the higher end. It's staying lower. But as soon as trend starts to reverse, we're deviating away from the bands, then that's an indication that there perhaps is a trend reversal. And then as we're hugging the bands here, so the higher end of the price ranges during that period, so getting higher and higher, add in more prices to that movement. Now all of a sudden the moving averages are moving up. As soon as we deviate from that, that gives us indication of the trend is waning, it's fading. It fails to find support on that moving average or wherever your defined support line is, which is probably about here, then the trend reverses. And you'd keep following this pattern constantly, right? So that's how I would personally utilize standard deviations or Bollinger Bands. And it's utilized in lots of different ways, but it's areas of support and resistance. I like to use it as trend strength and more on weekly charts, because that, again, is my personal preference, is weekly charts. So the math, though, is price movement. Is it hanging on to the lower end of the price movement or the higher end of the price movement? And if there's higher and higher prices, that means higher highs and higher lows, then that's indicative of trend strength and higher trend strength, and we could expect that continuation until something gives us otherwise. All right. Moving on. We could layer on top of that leading indicators, which are oftentimes you'll hear RSI talked about quite a bit, or MACD or stochastics. Those can be utilized in lots of different ways. So if we have MACD, for example, that utilizes something called an exponential moving average. An exponential moving average, instead of like a simple moving average, is going to apply equal weight to all of the prices within the time frame that you've you've selected. An exponential moving average puts more weight on the most recent prices. That's how it becomes leading, because the most recent has more movement, if you will, moves it first. So something like MACD, if there is a cross above the signal line, that's indication that trends are reversing. Cross below, the opposite is true. Whereas if we add RSI, again, there is standard deviations and then it's normalized from 0 to 100. Normally you'll see a 70-30, here it's an 80-20, indicating that something is overbought or oversold. If you are thinking about trend, and oftentimes you'll hear on the market, or even lately, as with NVIDIA or those other securities, will say, "Oh, it's looking oversold." Well, maybe not necessarily, because if the math of that is standard deviations and it's hanging to the higher end of that variation, then that is actually confirmation of the trend. But it could give you an indication that it's waning if you layer it on with other aspects. So the point is, you can't utilize any indicator on its own. They tend to fall in different categories, and I've given you those varying categories today, which is trend, volume, trend strength. Those, utilizing those, and momentum, utilizing those together will help create a clearer picture. Nothing's ever perfect. You can't rely on it individually, but it is more information to help you make more informed decisions. All right. My screen isn't allowing me to move on to the next one for some reason. Just give me one moment. There we go. Sorry, my screen stopped for a moment. I'm bringing it right back. So give me one moment. I apologize. All right. So this is the screen I want to bring you back to, is looking at the strategies that we would utilize in order to deploy our view. So remember, trades generate profits, not technical analysis. Trades also generate losses, not technical analysis. Trades are what are the action aspect from our understanding. So this is the takeaway for you to mull on, if you will. So if you are expecting sharp movement, you have a clear resistance zone. This is your magnitude and the types of trades that you can layer on. When we are talking about option strategies, we look at risk versus reward, and we look at probability of profit. Probability of profit is higher for options that you sell because you don't need a sharp movement in order to be profitable. However, sometimes your risk can be higher. Whereas options that you purchase, your probability of profit is lower because you require a sharp directional move, but your risk versus reward could be higher because oftentimes you're spending less money. So one requires you to spend money, the other one you receive money. That's the difference there. And a lot of what we talk about when we utilize option strategies and the options wizard, which is found on First Trade's platform, is you'll specify the underlying security. There will be a technical view. You can layer on your technical view, and then it's going to lay out the risk versus reward for you. How much am I risking versus how much I reward in the terms of numbers? That's the aspect that you want to layer on when you are defining your areas of support and resistance and clear trend lines when you're layering on your process. All right. Nonetheless, I feel like I flew through that one today, but it is the intro to technical analysis and then layering on option strategies there. So the goal of today was for you to understand areas of supply and demand, support and resistance, how to identify a trend, utilize moving averages, layer on Bollinger Bands and leading indicators as well. So I do have the Q&A open if there are any questions, and we can certainly cover that. And do that for about 5 minutes, and we'll go from there. How do you deal with fake breakdown and breakouts? Says Chris. That is a wonderful question. You look for validation. A breakout and a breakdown is terms for investigation. That is a signal, that is a flag that must be validated. So, is there a breakout with a change in the MACD or a confirmation with RSI? So, is it showing oversold with a breakout, or is it showing overbought with a breakdown? That is your what I would be looking for. Validating it with other indicators. Trend strength, is it hugging the Bollinger Bands? Which leads into Dominic's questions. How might you interpret periods of lesser and greater standard deviations, e.g. Bollinger Bands narrowing and widening in terms of predicting possible trend change? That's a wonderful question. So if you think about what Bollinger Bands are, let's go to that slide. They are standard deviations. So when you see the bands squeeze, that's normally indicative of a trend change because prices are finding that value, meaning something could come in and change it very quickly. When it widens, there's more volatility. There's higher volatility because there is higher price variance. Volatility and uncertainty are synonymous terms in my view, meaning this widens here, there's price variance, uncertainty tends to go with sell-offs because emotion comes in. Are there studies proving the success of technical analysis, says Dr. Goldstein? There are lots of studies that you can pull, and there are lots of back testing you can even pull. And what I've seen just for my personal use, and there is lots you can pull, normally research reports as well. It's something that has to be done with layers. It's not if anyone who relies on one indicator will be incorrect. But there are some where it's probabilities are what you're layering on top of it. Looking at something with a monthly view and it breaks and there's a MACD signal change, normally that is indication, and you might hear seasonality or words like that thrown around Wall Street and finance media all the time. There's always a number associated with that. 50% of, or like October tends to always be the worst month of the year from a seasonal perspective. We'll say how much it's up or down percentage of the time. So that's your, I wouldn't say success of technical analysis, but it would be the probabilities of this being true, the percent that this has been true, which will then you can utilize from there. Well, that's a great question. I like that question there. What is the best chart to use for 30-day covered calls, like 5 minutes, weekly, etc.? So that is a personal preference as well, Jamie. So if you are selling Jamie's saying he's selling covered calls, and it looks like he's doing it every 30 days. And if you are selling calls every 30 days, one, you are owning an underlying security, which means you're bullish. And when you sell a covered call, you're creating your area where you're okay selling that security because you're creating an obligation to sell that stock. So if it's a 30-day period, again, personal preference, I layer on weekly and daily charts. I hardly look at 5 minutes because it's a lot of noise. We take out the noise to take out noise and look at the trees through the forest through the trees is longer time frames. So if it's something that you want to hold for a longer time frame, I want to see where things will be on every 30 days or so. I would personally use a weekly or a daily chart for that. But again, it's a personal preference. Jariant says, what are your top 3 technical analysis signals? Okay. I prefer to utilize 13, 26, and 40 weekly moving averages as my trend. And that's because 13 weeks represents 1 quarter worth of prices. 26 is 2 and 40 is 3. That gives me what I call the trading cycle. As long as those moving averages, this middle here is a moving average, so there'd be 3 of those. And if it is a moving average with a lot more time, so the 40 versus the 13, it'd be a smoother line. So again, less noise. I want to see all of them trending upwards. So as I see it flatten, then that gives me an indication of trend movement. And I use that on a weekly chart with a 2 to 3 year, usually a 3 year view. And that's indicative of when we get earnings to earnings, quarter to quarter, are prices increasing or are prices decreasing? That's my first step. And then I do like to use Bollinger Bands for trend strength. I layer on the 200 weekly to give me an idea of the overall larger trend. The 200 weekly, I encourage you to pull up the major market indices on a 3 year chart and see where the 200 weekly falls. That tends to help. But when it depends on what you're analyzing, you can utilize this type of method on the overall market, sectors, individual securities, so on and so forth. And that can help speak to other things. Meaning if we know the S&P 500 is heavily market cap, it is heavily market cap weighted, 30% of which is technology as measured by the S&P 500 or the SPY ETF. So perhaps seeing technology where it's moving, since it has the ability to move the overall market, then that's an indication. So there are lots of signals that I like to use, and yeah, you hit the nerd in me there. So I thank you for that question. And Chris asks, how do you see how bullish or bearish price action is? Well, that's just areas I don't think you have to overcomplicate that one, Chris. That's why I like starting with this one. It's areas of supply and demand. Here are the bulls, here are the bears in this area. This is really a neutral strategy, but if this was a larger time frame, it depends on how long this could be. Remember, this is an earnings and this is an earnings date. So this is 3 months of data here. So it really depends on other factors as well, but it's bulls are coming in and overcoming areas of that are clear areas of resistance, otherwise supply. And then that's confirmed with momentum in overbought and oversold, trend strength, and you can layer on lots of other indicators. There's about 42 on there. Okay. So it looks like we got through all those questions. So I appreciate everyone joining today. And again, thank you for taking the steps to learn about the wonderful world of technical analysis and options. This is, again, for those educational purposes. So making investment in your education is always a wonderful thing. So thank you again, and I hope to see you soon. Everyone have a wonderful day.